The U.S. disrupts supply chains and raises risk of global recession. The United States is increasing pressure on countries to choose sides between Washington and Beijing, particularly in the high-tech sector. Could the U.S.-China tech confrontation pull the entire world into a new economic downturn? The United States is advancing a strategy aimed at distancing China from the global supply chain, particularly in the high-tech sector. The Washington administration has expanded export control measures, not only applying them to American companies, but also requiring foreign firms to choose between cooperating exclusively with the U.S. or with China. According to Bloomberg, the U.S. has imposed an additional 20% tariff on a wide range of Chinese products and has further extended its chip export restrictions. The restrictions on chip exports to China have also resulted in significant losses for American businesses and their global partners. According to Bloomberg, October 2024, NVIDIA is expected to lose $5.5 billion in revenue due to its inability to sell advanced AI chips to China, an amount equivalent to roughly 20% of its projected 2025 revenue. ASML, Netherlands, the world's leading manufacturer of chip printing machines, has warned that its revenue from the Chinese market could decline from nearly 50% to just 20% by 2025. Companies such as Tokyo Electron, Japan, and Samsung, South Korea, face similar risks. Disruptions in the global chip supply chain are likely to drive up the prices of consumer technology products, such as smartphones, laptops, and electric vehicles, due to increased production costs. Furthermore, if companies are forced to reduce investment and cut jobs to offset losses, the risk of rising unemployment in the tech sector will grow. The impact of the U.S.-China competition, combined with rising protectionist policies, is fueling concerns about a potential global recession. According to an end-of-year 2024 report by the International Monetary Fund (IMF), the risk of a global economic downturn in 2025 stands at 30%, more than double the level recorded the previous year. In December 2024, the European Central Bank (ECB) announced it would continue to lower interest rates, following a drop in Eurozone inflation to 2.4%, the lowest level in nearly 2 years. As central banks tighten policies to manage risk, businesses may face greater difficulty accessing capital, which could hinder growth and employment. In the United States, the Federal Reserve has maintained a cautious policy stance, while consumers are increasingly tightening their spending. This reflects mounting pressure on everyday life, with persistently high prices for essentials such as food, energy, and loan interest rates for home and auto purchases. According to a survey by the Conference Board, U.S. consumer confidence dropped by 9 points in the fourth quarter of 2024, driven by concerns over prolonged inflation and rising living costs. In November 2024, former President Donald Trump announced that he would replace Federal Reserve Chairman Jerome Powell if reelected, stating that Powell does not support his economic policies. This statement has raised concerns in financial markets about the potential loss of the Fed's independence, an essential factor in maintaining monetary stability. At present, the Fed has no stated plans to intervene should a market crisis occur, raising questions about its ability to respond effectively in times of major economic volatility. Since late 2024, foreign investors have begun withdrawing from U.S. government bonds. Meanwhile, gold prices have risen by 14% in just 3 months, signaling a growing trend toward risk aversion. For American households, this environment means higher mortgage and consumer loan interest rates, while a weakening U.S. dollar is driving up the cost of imported goods. If the Fed were to lose its independence, monetary policy could become more susceptible to political influence, directly impacting consumer spending, price stability, and employment opportunities. China unexpectedly halts U.S. beef imports, disrupting $2.5 billion in exports. What's behind the move, and who stands to lose? As of March 16, 2025, China has not renewed import permits for over 300 U.S. beef processing facilities, rendering a significant portion of American beef exports ineligible for entry into the Chinese market. This move follows the United States' decision to impose a 25% tariff on Chinese electric vehicles and related components, and is widely seen as part of Beijing's broader trade response. According to U.S. government data, beef exports to China plunged from an average of 2,000 metric tons per week to just 54 tons in the week ending March 20. China has also imposed additional tariffs of 10% to 15% on U.S. agricultural products, including beef, making American goods less competitive in the Chinese market. In 2024, the U.S. posted a record $8.63 billion in pork exports, with total volume reaching 3.03 million tons. Beef exports contributed $10.5 billion, accounting for roughly 14% of total domestic production. China has played a key role in this growth, representing 14% of U.S. beef export volume and 15% in value, along with 15% of pork volume and 13% of its value. Since March 2025, however, China has levied steep tariffs, 56% on U.S. beef and 81% on pork, further eroding the competitiveness of American meat products and triggering a sharp decline in exports to this vital market. As a result, surplus supply is building up domestically, putting downward pressure on prices. According to the U.S. Department of Agriculture, USDA, wholesale beef prices fell 1.9% in February 2025, while pork prices dropped 6.2% in January, before rebounding 7.9% the following month. While the price decline may benefit American consumers in the short term, with more affordable meat at the grocery store, long-term disruptions in export channels could reduce farm incomes, affect employment in food processing, and impact related agricultural commodities, such as corn and soybeans. In the wake of China's higher tariffs on U.S. beef and pork, Russia has seized the opportunity to strengthen its presence in the Chinese market. Sergei Dankvert, head of Russia's Federal Service for Veterinary and Phytosanitary Surveillance, Roskosnadzor, stated that Russian meat exports are expected to reach 1 million tons in 2025, up from 860,000 tons in 2024. China, the world's largest consumer and importer of beef, brought in a record 2.87 million tons in 2024. Russia's pricing and quality advantages are positioning it as a key alternative supplier. The expansion of Russian meat exports may also help stabilize domestic Chinese meat prices, especially as beef prices fell by 22% in 2024 due to oversupply. Rising beef imports in China reflect increasing consumer demand, driven by higher incomes and a growing preference for premium meat products. To reduce dependency on a limited number of suppliers, China has broadened the list of approved beef exporters. Recent policy changes have allowed more producers from Australia and Russia to enter the market, while easing restrictions on German beef. Other key suppliers include Brazil, Argentina, Uruguay, Belarus, and Chile. For Chinese consumers, this diversification helps ensure supply stability and price consistency, meeting the country's growing demand for beef. For the U.S., however, China's strategic pivot in sourcing could lead to prolonged oversupply in the domestic beef market, with potential implications for pricing and agricultural sector stability. The United States has imposed record-high tariffs on Chinese goods, but the question remains, which side stands to lose more? While China responds with currency devaluation and redirects its exports, the world now faces the risk of deepening divisions. In the first quarter of 2025, the administration of President Trump imposed record-high tariffs, with some products reaching as high as 145% on imports from China. aiming to reduce dependency and pressure Beijing to make concessions on trade and technology. According to AP News, however, but as import costs rose rapidly, many small American businesses were forced to raise prices, cut staff, or withdraw from the market. A retail company in California reported having to pay nearly $630,000 more per year due to the new tariffs. A coffee machine that used to cost $120 has now risen to over $180. This has caused consumers to become more cautious in their daily spending. The ripple effect has also placed the Federal Reserve, the Fed, in a difficult position. If it maintains high interest rates to contain inflation, it risks stifling growth. But if it lowers rates to stimulate demand, it puts pressure on the US dollar. By the end of March 2025, the Consumer Price Index, the CPI, had risen by 4.2% compared to the same period last year, the highest in 18 months. In this context, households with young children or elderly members are especially affected, as healthcare and food costs have surged. Immediately following the United States' decision to raise tariffs on Chinese goods to as high as 145%, Beijing allowed the renminbi to depreciate significantly. This devaluation made Chinese exports more affordable in global markets. According to a report from Bloomberg, in April 2025, the RMB-USD exchange rate dropped to 7.4290, the weakest level since 2010. However, Chinese consumers are now experiencing price increases of 10 to 20% on imported goods compared to the beginning of the year. Many households have begun to shift their preference toward domestic products. At the same time, China swiftly restructured its export strategy, redirecting a large share toward ASEAN and Europe. According to Global Times, in the first quarter of 2025, exports to ASEAN rose by 20.3%, especially in categories such as lithium batteries, auto parts, and consumer electronics. As for Europe, the World Trade Organization, the WTO, projects that Chinese exports to the region could increase by an additional 4 to 9% in 2025. One outcome of this shift is that many Chinese workers are now required to retrain and acquire new skills in order to adapt to changes in production lines, which may temporarily disrupt their incomes. According to AP News, in the first quarter of 2025, China's GDP grew by 5.4%, exceeding the projected 5.1%, largely due to a surge in exports prior to the implementation of new U.S. tariffs. Nevertheless, falling real estate prices and a 9.9% decline in property sector investment have raised concerns among many households. Asset values have dropped, and low inflation has contributed to a slowdown in the domestic consumption, although exports increased by 6.9%, enabling China to post a trade surplus of 1.96 trillion yuan in the first quarter. A 6% drop in imports has led many families to reduce their purchases of imported goods. In April 2025, the US dollar fell nearly 10% from its peak earlier in the year, marking its sharpest decline since 2022. The USD index dropped below the 100-point threshold, reflecting a weakening of global confidence in the dollar. Prices for imported goods, such as electronics and food, have risen. In addition, interest rates on home and consumer loans have also increased, making everyday living costs more burdensome. President Trump's trade and diplomatic policies are contributing to a growing divide between the United States . The U.S. hits China with a 245% tariff, Beijing strikes back, Trump claims prices are falling, and New York's Attorney General faces a mortgage fraud probe. Where will this trade standoff lead? Toward negotiation or escalation just months before the election? On April 17, 2025, former President Donald Trump announced a 245% tariff on Chinese imports, pressuring Beijing to appoint an official trade representative and return to the negotiating table. The move is aimed at securing more favorable terms for U.S. trade and curbing what Trump described as unfair economic practices by China. If talks proceed successfully, stabilized prices on Chinese consumer goods, such as clothing, electronics, and household items, could relieve pressure on U.S. households. Currently, steep tariffs have raised costs across the board, directly impacting American consumers' daily expenses. Experts suggest millions of American families could benefit from more balanced trade terms, easing inflation concerns and improving domestic economic stability. Before signaling openness to talks, China launched significant retaliatory measures. Beijing canceled all pending aircraft orders with Boeing and banned the purchase of U.S. planes and aerospace components. More critically, China suspended exports of 6 key rare earth minerals, essential to U.S. defense and high-tech industries. This rare earth embargo poses a serious threat to American manufacturing supply chains, particularly in electric vehicles, smartphones, computers, and weapons systems. If prolonged, the move could drive up production costs, leading to higher retail prices and impacting both consumers and workers in affected industries. Following April 5th remarks, Trump claimed that prices on gasoline, food, and mortgage rates have declined. He also said tariff revenue is pouring in and fueling the U.S. economy. However, Treasury Department data shows daily tariff revenue averaged just $259 million in February and $263 million in March, well below Trump's claim of $2 billion a day. Meanwhile, housing supply has reached a 15-year high, with over 500,000 newly listed homes across the country. The surge in supply may help ease housing prices, providing more opportunities for working families and first-time buyers. Still, some economists warn the trend may be temporary and not reflective of long-term market shifts. According to a recent University of Massachusetts Amherst poll, just 2% of Trump voters say they would change their vote if given another chance, down from 3.5% in 2017. This signals strong loyalty among Trump's base and suggests he could maintain significant grassroots support heading into the 2024 election. Such unwavering backing could shape U.S. policy direction on trade, taxes, and immigration. If Trump returns to office, potentially leading to extended tariffs, tighter immigration controls, and a more inward-looking economic strategy, directly affecting jobs and consumer prices. New York Attorney General Letitia James, known for high-profile lawsuits against Trump, is now under federal investigation for alleged mortgage fraud. Reports claim she misrepresented her primary residence and marital status to obtain financial benefits, potentially violating federal lending laws. If the allegations are confirmed, the case could undermine public trust in the justice system and raise concerns over whether powerful figures are exploiting financial systems that everyday Americans increasingly struggle to access, especially in securing home loans amid high interest rates and strict lending standards. In a strategic shift, the United States has temporarily suspended additional tariffs on over 75 countries, while intensifying its trade stance toward China. What lies behind President Trump's recalibrated trade approach? On April 9, 2025, President Donald Trump announced a 90-day suspension of new tariffs for most trading partners, excluding China. The move aims to create a window for constructive trade discussions. At the same time, import tariffs on Chinese goods have been raised to 125%. According to President Trump, the measure targets countries that have responded with retaliatory actions. In contrast, nations that OPT for dialogue will benefit from the temporary freeze. Markets responded positively to the announcement, with the S&P 500 climbing 9.5%, its strongest performance in years. Financial analysts view this as a sign that the U.S. is seeking a balance between applying pressure and encouraging diplomatic engagement in international trade relations. In his April 9th address, President Trump emphasized China's role as the U.S.'s largest trading partner, noting the significant trade imbalance. According to the Office of the U.S. Trade Representative, the U.S. imported approximately $438.9 billion in goods from China in 2024, while exporting around $143.5 billion, resulting in a goods trade deficit of $295.4 billion, an increase of 5.8% compared to 2023. Rising deficit. The continued growth in the trade deficit highlights a deepening imbalance in bilateral trade relations. Data discrepancies. There remains a gap between official figures from the U.S. and China. While the U.S. reports a $295 billion deficit, Chinese authorities have cited a $360 billion surplus. Sector impacts. Prolonged trade deficits may affect key U.S. industries, particularly those directly competing with Chinese imports, such as consumer electronics, textiles, and toys. President Trump noted that China has expressed interest in reaching a trade agreement, but appears uncertain about the path forward. They don't know how to get there, he remarked. According to Al Jazeera, U.S. trade officials indicated that Beijing has yet to formally pursue new negotiation rounds. That same day, the U.S. raised tariffs on Chinese goods to 125%, while extending a tariff freeze to other nations. In response, China convened emergency meetings and vowed to fight to the end, announcing plans to impose retaliatory tariffs on U.S. products. President Trump also stated that more than 75 countries have approached the U.S. to initiate discussions on trade, tariffs, and market access. These countries have refrained from retaliatory measures and expressed a willingness to pursue mutually beneficial solutions. Global reaction. The wide interest in engaging with the U.S. reflects international concern about the evolving American tariff policy and a shared desire to preserve stable trade relations. U.S. negotiation strategy. The Trump administration is expected to pursue individualized negotiations with each country, aiming for tailored bilateral agreements. Treasury Secretary Scott Bessent noted that each solution would be custom designed, and the president intends to play a direct role in the process. Concluding his remarks, President Trump expressed strong confidence in the nation's economic trajectory, predicting unprecedented breakthroughs within the next year. He asserted that the new trade policies would stimulate economic growth and generate jobs. Indeed, U.S. stock markets have shown notable recovery. However, some economists have raised concerns about the potential for an economic slowdown if tariffs remain in place. J.P. Morgan Chase & Co. has projected a risk of recession later this year, should current tariff strategies persist.